The headlines are screaming recovery. September 2025 just posted the biggest sales numbers since 2021. Realtors are popping champagne. But behind those celebration-worthy numbers lies a brutal truth that could define who wins and who loses fortunes in the Canadian housing market over the next 12 months. Housing Intel Canada is about to show what the data actually says. According to the Canadian Real Estate Association, 39,938 homes sold in September. That's 5.2% higher than last year and marks the strongest September performance since 2021. Sales to new listings ratio sits at 50.7%, balanced market territory. Everything looks great, right? But here's what they're not telling you. While sales hit 4-year highs, inventory exploded 7.5% year-over-year. Toronto now has 27,386 properties sitting on the market. That's the highest level since 1996, nearly 3 decades of records shattered. Vancouver is drowning in 17,000 active listings with 9 months of inventory. And get this, 2,500 brand new condos in Metro Vancouver are sitting completely empty. No buyers, no tenants, just vacant billion-dollar inventory gathering dust. How is it possible that sales are surging while inventory is suffocating markets? That's the paradox nobody's explaining. And understanding this contradiction is the difference between making the best or the worst financial decision of your life in 2025. If you want real estate intelligence that cuts through the noise and shows what's actually happening in the Canadian market, subscribe to Housing Intel Canada right now. Hit that subscribe button and turn on notifications because this channel delivers the data-driven insights that matter. Housing Intel Canada is breaking down what's really happening region by region because Canada isn't one market. It's multiple markets moving in completely opposite directions. Toronto's benchmark price dropped 5.5% year-over-year, according to WOA data. But that number hides the real carnage happening in specific segments. Condos are getting obliterated. The condo market now has 58 months of inventory. Read that again, 58 months. That's 14 times higher than 2022 levels when the market was red hot. The sales to new listings ratio for Toronto condos crashed to 29%. Anything below 45% is considered a strong buyer's market. 29% is extreme buyer territory. This means for every 10 new condos listed, only 3 are selling. 7 are sitting, accumulating days on market and becoming increasingly desperate listings. Here's why this matters. When sellers realize their property isn't moving, they drop prices. When multiple sellers drop prices simultaneously, it creates a downward spiral. Bloomberg reported that Toronto's correction could extend another 12 to 18 months before finding a bottom. That means if you're buying a condo in Toronto right now, you're catching a falling knife. But if you're a strategic buyer waiting on the sidelines, you're watching one of the greatest wealth transfer opportunities in Canadian real estate history unfold in real time. The contradiction? While condos collapse, detached homes in premium neighborhoods are still getting multiple offers. Why? Wealthy buyers are immune to interest rates. They're paying cash or putting down 70%. They don't care if the Bank of Canada's overnight rate sits at 2.25% or 4%. They're buying scarcity, detached homes in established neighborhoods with good schools. That segment is holding. Everything else is sliding.
Vancouver's situation is even more fascinating. The city, famous for being unaffordable, is now dealing with 2,500 brand new condos that nobody wants. Developers are offering incentives, free parking, upgraded appliances, covering legal fees. Nothing's working. Why? 3 factors converged simultaneously. First, mortgage rates. Despite the Bank of Canada cutting rates to 2.25%, the best 5-year fixed mortgage rates still hover around 3.79%. That's significantly higher than the 1.5% rates buyers enjoyed in 2020 and 2021. Monthly carrying costs are 50 to 70% higher than 4 years ago. Second, speculation dried up. During the pandemic, investors bought pre-construction condos expecting massive appreciation. Many of those units are now completing. Investors are trying to flip or rent them out. But rental yields in Vancouver barely cover expenses. And selling means taking a loss because prices dropped 2.7% year over year. So they're stuck. Some are walking away from deposits. Others are desperately holding, bleeding monthly costs, hoping for a rebound. Third, immigration. And this is the hidden factor nobody's talking about loudly enough. The Canadian government cut immigration targets from 500,000 to 395,000. The Parliamentary Budget Officer released a stunning report. This reduction eliminates the need for 534,000 housing units by 2030. 500,000 units of demand just evaporated from projections. Vancouver was built on immigration-driven demand. Chinese buyers, Indian families, international students. That pipeline slowed dramatically. And when demand drops while supply surges, prices collapse. It's Economics 101. Vancouver's inventory now sits at 9 months of supply. A balanced market is 4 to 6 months. 9 months means sellers are competing aggressively. Buyers have all the leverage. If you're shopping for a condo in Vancouver right now, you're in the driver's seat. But you need to be strategic. Not every condo is equal. Transit-oriented developments near SkyTrain stations will recover faster. Buildings with massive strata fees or deferred maintenance, those are value traps. The exceptions, where Canada is actually booming. Here's where the story gets interesting. While Toronto and Vancouver struggle, other provinces are thriving. Quebec's benchmark price surged 8.1% year over year. Saskatchewan posted a sales-to-new listings ratio of 73%. That's a raging seller's market. Newfoundland prices jumped 10.3%. Why the disconnect? Affordability and migration. Canadians are leaving expensive cities and moving to cheaper provinces. A family in Toronto paying $3,000 a month for a 2-bedroom apartment can buy a house in Quebec City or Halifax for the same monthly payment. Remote work made this possible. And once people realize their quality of life triples by leaving Toronto or Vancouver, they don't come back. This internal migration is reshaping Canada's housing geography. The provinces that offered affordability are now seeing price pressure. Meanwhile, the expensive markets are experiencing the first sustained correction in decades. This trend has at least 3 to 5 more years to run.
Calgary's the perfect case study. The city saw explosive growth from 2021 to 2024. Benchmark prices jumped from $537,000 to $757,000 in 3 years. That's a $220,000 increase. But in September 2025, Calgary's benchmark price fell to $572,800, down 4% year over year. Inventory surged 36%. The sales-to-new listings ratio dropped to 45%. Calgary is transitioning from a hot market to a balanced market. For buyers, this is ideal. You're no longer competing with 10 other offers. You can negotiate. You can do inspections. You can take your time. For sellers who bought in 2024 at the peak, this is painful. But for strategic investors watching fundamentals, Calgary represents a long-term opportunity. The city has strong job growth, no provincial sales tax, and is attracting corporate relocations. Everything described so far assumes interest rates stay relatively stable. But what if they don't? The Bank of Canada cut rates to 2.25% in October 2025, but inflation is creeping back up. September's inflation hit 2.4%, above the 2% target.
Core measures are trending around 2.5%. If inflation continues climbing, the Bank of Canada might pause further cuts or even reverse course. That would be catastrophic for the housing market. Higher rates mean higher borrowing costs. Buyers who are already stretched would be priced out entirely. Sellers who need to move would be forced to cut prices aggressively. Conversely, if the economy weakens further and the Bank of Canada cuts rates to 1.5%, that could reignite demand. Suddenly, buyers who were priced out can afford 20 to 30% more house. That would stabilize Toronto and Vancouver and potentially create another boom cycle in affordable provinces. The next 6 months of interest rate decisions will determine whether Canada's housing market finds a floor or continues sliding. And nobody knows which way it's going. Not economists, not the Bank of Canada, not realtors. This is the ultimate uncertainty.
What this means for you. If you're a buyer, you have more power than you've had in 5 years. Inventory is high, sellers are motivated, interest rates are falling. But don't rush, the market hasn't bottomed yet. Toronto condos have further to fall. Vancouver condos are still overpriced relative to fundamentals. Calgary is stabilizing, but hasn't found its floor. The best strategy? Wait for capitulation. That's when sellers give up hope and accept reality. You'll know it's happening when listings flood the market, price cuts become standard, and days on market stretch past 60 days. Housing Intel Canada is tracking these indicators in real time across every major market. The data hasn't shown capitulation yet in most markets, but it's close. If you're a seller, the window is closing. The longer you wait, the more competition you'll face. Inventory is building. Buyers are getting pickier. Every month you delay is a month of carrying costs and potential price depreciation. If you need to sell, do it now. Don't wait for spring. Spring 2026 might be worse. If you're an investor, this is a tale of two markets. Premium properties in prime locations will hold value. Everything else is at risk. Condos in secondary locations with high fees? Avoid. Detached homes in established Toronto neighborhoods near good schools? Those will recover fastest. Calgary single-family homes? Solid long-term hold. Vancouver condos? Only if you're buying at a 30 to 40% discount from peak. Canada's housing market is hitting 4-year sales highs while simultaneously drowning in inventory. That's not recovery. That's contradiction. And contradictions resolve violently. Either sales collapse and prices crater further, or inventory gets absorbed and prices stabilize. The next 12 months will tell us which path we're on. What's clear is this: the era of blind bidding wars and guaranteed appreciation is over. The market is now about fundamentals: location, cash flow, carrying costs, exit strategy. The investors who understand this will build wealth. The ones chasing headlines will lose fortunes. This is Housing Intel Canada, real estate intelligence based on data, not hype. If you want to stay ahead of market shifts before they become mainstream news, subscribe to the channel right now. Hit that like button, drop a comment with your thoughts on the Canadian market, and follow Housing Intel Canada for weekly analysis that cuts through the noise. The Canadian housing market is about to get very, very interesting, and Housing Intel Canada will be here every step of the way to decode what's really happening.